Dear traders, this is Trading Up here. Today we're going to be sharing an exciting correlation coefficient, well, correlation idea between that you can use to when you analyze certain pairs. So without wasting any time, let's get right straight into it. So here we've got USD JPY 4-hour time frame, and we see that the market rallied up, it consolidated, then rallied up against the downside. Now that is a Wyckoff reaccumulation schematic type of pattern. Now, this is USD JPY. What you can do to help you analyze the market is you can go to JPY USD, which is the exact opposite. Just type the opposite. And look at that same area, what's happening. And here you see that the market rallied down, consolidated, then broke to the downside. This can help you with a lot of things because let's say you do see the rally down in the consolidation. Maybe you think this could probably be a potential Wyckoff accumulation schematic and break up to the upside there. But the fact that you saw that that went down and consolidated and broke structure there, and you saw that this one went up, consolidated, and broke structure here, this can help you to see that, hey, this is actually showing me some bullish momentum. We broke structure to the upside after a quick rally up to the upside. This has reaccumulation ideas. But you don't even need to know Wyckoff, because once you see prices breaking structure up there, and you see price break structure down here on the redistribution on the JPY USD, this can help you identify buyers. So whenever you find yourself getting confused, you don't know, should I look for a sell, should I look for a buy? This is a great idea that you can use. So here, if we analyze here, we can see that we had a low, we had a high, and we broke that high to the upside. Therefore, we had a break of structure to the upside. If we have a break of structure to the upside, we should always look for a buy. We then mark our order block. Take an entry here. Stop loss about there. Target 1 to 5. And you can see with lower. And there you can see we've easily met up. We could have even got like 1:10 here. But you must always remember, let's say you aim 1:3 and the market gets 1:10. You mustn't be worried. Don't say, oh, I should have held it longer, because that's going to make you become more greedy and you're not going to be as focused on your strategy in the future. So here we had the same idea. We broke structure to the downside. We then formed our pattern, our order block. We sold. And we aimed about 1:3. You'll see we easily met our take profit target. As you can see, the stop loss is quite big. You could have obviously made it smaller, could have got a higher RR. Depends on the person. But ideally, you should want to at least put your stop loss around about at this area. Around about here. So as you can see, traders, we've analyzed two pairs, USD JPY and the opposite, JPY USD. Just type those two. You can even do this with Euro USD. You'll just then type USD Euro. And then you'll look at what is the one doing and what is the other one doing. If USD Euro breaks the downside and you see like a order type of pattern forming, and Euro USD breaks the upside, then you know that you can buy the one, you can sell the other one. This gives you great confirmation for your trades, even especially when you may feel confused. And as you can see, traders, don't take Wyckoffs too seriously. For example, I didn't really have to say that this is a selling climbers automatic secondary test, down thrusts, and then spring, etc. I really didn't need to do that. but you can if you want to. For example, you can say selling climax here, automatic rally, secondary test, down thrust, and a spring, broke structure just below there, taking out the liquidity, because you must remember below these lows we've got liquidity there. Right there, we took out that liquidity. The liquidity has been taken below that previous low. We broke structure to the upside. We retraced the order block. We took our entry. We got our RR. And as you can see, this was a limitless opportunity. We could have gotten a 1:2, basically a 1:25 of this setup. Beautiful setup. Very beautiful. And we could have done the exact same thing on this one here. We could have got our buying climax here. See guys, I don't want you guys to be very strict on the number. You must more understand what's happening. Liquidity is being taken to the upside. We then have a break of structure to the downside. We then look for that order block and then we take our entry. Here we've got up thrust. Then we've got our U-tag. Then after our U-tag, we broke structure to the downside, taking out the liquidity. Taking out that money that was sitting there, taking out those stop losses, because you must remember, some people who trade retail, they may be like, oh, this looks like a support area. Let me buy there. Unknowingly, that's going to be taking out people's stop losses, retracing back there. People still trying to hold, maybe the market will go up. You'll take out the further stop losses sitting over there, while that is your take profit. So thank you very much, traders. Hopefully you've learned here. In this idea, it was basically showing how you can utilize divergence between various currency pairs, divergence between RSI, which will come up in another video, in your trading. This will alleviate confusion and allow you to be more selective in your trade setups. Thank you very much, traders. Enjoy your day.